Hello and welcome to the Life by Design podcast, brought to you by Strategic. This podcast is all about helping you live your great life. Each episode will feature insights from our Chief Investment Officer, Doug Walters. Hello and welcome back to the Life by Design podcast. Joining me once again is Doug Walters.
Hi, Jay. How are you doing?
Fantastic. Well, we have another topic today that is as confusing as ever to me, and so
Join the club.
Yeah,
Join the club.
I'm hoping you can clarify this. So basically, this past week, your written insights on our blog was titled "Debt and Stocks: A Tale of Two Timelines."
Right.
And the things that really triggered this was that Moody's downrated the United States credit. Is that correct?
Yes.
Credit
rating. Yep.
And then the House bill passed that is going to put the United States in more debt.
Right. Yeah, that is estimated to increase the debt over time.
Right. And it still has to go to the Senate, and there's news that they're going to change it anyways. But the House passed it. It would add $3.8 trillion in debt.
Right. That's the current estimate.
Already 36.9 national debt.
Yes.
Yeah. So 10%.
Yeah.
so what does that all mean?
Yeah. Good. Well, let's get into it.
Yeah.
So the Moody's downgrade is, in a way, could argue they're late to the game. S&P downgraded the U.S. a while ago, and this is a downgrade from AAA to AA plus in the case of S&P, and with a stable outlook. So not a horrendous credit rating, but it's a downgrade, and it is it's a reflection of the increasing national debt and the impact that would have on the U.S. over time to be able to pay its bills.
And this is my own ignorance. Were we the only AAA rating, or are other countries at a AAA rating as well?
Well, you're not the only one ignorant on that.
Okay.
I have no idea.
Yeah. All right.
Sorry.
No, that's okay. And so, the reason it kind of, it's news, but not really big news, is that because we're still kind of our dollars still the value that everyone bases their dollars on as well.
Yeah, it's called the reserve currency,
Okay.
right? The U.S. is the go-to currency for transacting across the world, and it remains so even at a downgraded credit rating.
So literally that meant nothing.
Not to say it means nothing.
Okay.
So a looming debt burden is a serious thing.
Yes.
Right. And there is, something at some point has to be done.
Mm-hmm.
So either austerity measures like they've done in the UK, really trying to budget for the future and bring that debt down over time, or they don't, and eventually the market loses confidence in the U.S.'s ability to pay its debt, and sort of a worst case scenario. So it will get resolved one way or the other, but this is a reflection of the fact there is a problem to solve, and it is looming, and it is there, and it is real, and it needs to be solved.
And again, another ignorant question here, but several years ago during the Clinton administration, if I'm remembering correctly, they actually pulled us out of debt and put us into a surplus during that time. And so it seems to me, and I understand the dollar amount is far greater at this point, but we've done it before and pulled out of debt, and so we could potentially do it again.
It is possible.
Yeah.
The burden is higher now than it was then, but we have been here before. I don't know the exact figures, but I think we're close to the levels of post World War II, if I'm not mistaken. So we've been at these levels before in times of real economic strain, on balance sheet strain. And as you mentioned, there was a point back in the 90s where you had an administration who arguably arm was being twisted a bit by a very conservative House, and they managed to balance the budget. And we also, if you remember that time period, this is pre-.com bust, so this is .com, the good part of the .com. And so things were really humming along from an economic perspective as
Mm.
well.
Okay. Yeah. So with all that news, how does this relate into the stocks in the market?
Yeah, and that's really the point of that we wanted to make here. So I don't have any sort of crystal ball on how this debt burden is going to play out in the future. But what I do want to warn is investors from from seeing this and being concerned that it is a near-term issue for their stocks. Not to say that stocks are going to go up. Again, we have no crystal ball here,
Yeah.
but it is not a death knell for stocks
Mm.
in the near term. And I'll give you an example in sort of the evidence that we look at. Real world example, Japan. So Japan, if we go back 25 years, had similar debt levels to what the US has right now.
Okay.
Roughly 130% of GDP plus. So that we're going back 25 years. Since then, it's only gotten worse. For the last 15 years, their debt to GDP has been over 200%, peaking around 260%.
Okay.
So much worse than the US. The yen is not the world's reserve currency, so they have fewer tools at their disposal in terms of getting themselves out of this. Yet the Japanese stock market is up 400% over the last 15 years. So that is less than the S&P 500. So, but still a pretty good return, and just a sign that, hey, this isn't necessarily a near-term indicator that your stocks are going down. And that's really the message that we want to get out there, is not to panic. Again, debt burden real, needs to be solved, but does that mean you need to exit U.S. equities? No, that is not the message that I would take away from this.
Yeah, and I just from hearing what you're saying here, it just reminds me of other podcasts that we've had in the past where we've talked about the news of today from a long-term standpoint doesn't necessarily affect the stock market long-term. And it might, for the day, the stocks might go down or up or whatever they end up doing. But this is a perfect example of, hey, Japan's been in debt for all these years at a high rate, and they're up 400% over 15 years, right? So like, it seemed to have no effect, quote unquote.
Yeah, and I wouldn't say no effect. Certainly, no one would want to be in the position that Japan is in,
right?
And their stock market has had historical challenges. But again, the point being, this isn't necessarily a near-term indicator. So we have, as you say, the near-term, almost the day-to-day reaction to the headlines.
Yeah.
Okay, and then we have the long-term, the really long-term potential impact if we don't solve this. That is going to be bad for U.S. stocks if this doesn't get resolved.
Right.
But in this medium term, 5-10 years, your guess is as good as mine. There's no reason why U.S. companies can't continue to produce profits, and ultimately, as an investor, that's what you're buying into, is their cash flow, their earnings, and there's no reason why they can't continue to be successful in the coming decade despite this looming debt burden. And just to put one more note on that, there's multiple dynamics at play here. The spending bill that's coming through Congress, for example, bad news potentially for debt. Yet there are things in there that could be stimulative to the economy, cutting taxes, increasing benefits to certain industries, right? These things can be stimulative to stocks in the short to medium term, even though they're a hindrance to the debt long term. So
for those of you listening, I just shook my head in bewilderment.
Well, think about it like this. Hey, we're I'm going to spend more as a country. I'm gonna cut your taxes, right? So that means the debt goes up, but also means Jay can spend more at the store. He can buy more toys and electronics and this and that, and that is good for the makers of those. So near term, they're selling more, their profits are up, investors are enjoying those returns. Long term, that's again not resolving the issue of this debt, which is a longer term issue that needs to be resolved.
Okay. It kind of makes sense.
Yeah, it kind of makes sense.
Yeah.
And again, the message is not crystal ball. There's no crystal
Right.
ball here, but we want to avoid market timing around these headlines because
Yeah.
these are not timable events. But we do also want to acknowledge and we talk about it a lot, but diversification.
Yeah.
Right. You shouldn't have all of your assets in U.S. stocks to begin with. They should be a part of a well-diversified portfolio that includes international stocks, emerging markets, bonds, gold. So we want to make sure we have that well-diversified portfolio that allows us to work around these issues.
Okay, Doug. And so, yeah, I think I'm somewhat more clear on that, though. It seems like a lot of this stuff we talk about is still a fog after we're done talking. So I may have questions in the future. But with that being said, what are we looking at for the week ahead?
Yeah, it's today, I think, is sort of the day as we look at this week. Today's the day. So we have the Fed coming out with their meeting notes. There's always an interesting read to get the sort of color behind their last non-move to see what they're saying. So we'll be looking out for that today, as well as NVIDIA results today. Obviously, one of the biggest companies in the world. So we want to see what they're saying about AI, tariffs, all of that.
Okay. All right. Well, thanks so much, Doug. Appreciate it.
All right. You're welcome. Thanks, Jay.
This podcast is for educational and informational purposes only. Please see the full disclosure in our show notes for more information.